I'm here to talk about a little bit about Bitcoin as an asset class, and some of you might know me from Nordnet. I work there as an investment coach, but like Esa said, I'm a passionate investor, and I'm here only by myself, as myself, and not like on behalf of Nordnet or giving their opinions or views on this topic. First, I discovered Bitcoin in 2011, maybe, so quite in the beginning. I didn't invest in it, like Thomas didn't when he even had some knowledge of it. Then I invested in it when it was like $70, and then I traded it back to fiat in euros when it was $140, and I was like, God damn, I'm a good trader. But afterwards, as we can see from the graphs from my presentations, I should have kept it. And after the years, I've looked from the sidelines how Bitcoin has acted throughout the years and seen a lot of cycles. Then I just decided that I need to invest some time in this matter. And after that, I've also invested some money in it as well. But remember that this whole presentation is only about Bitcoin, not like other cryptos, because in the crypto space there is a lot of bullshit out there, and you need to be careful. And had some notes in here I need to say. Yeah, I'm not also trying to convince you to buy any Bitcoin or any products related to Bitcoin. Here today I'm just giving my opinions and views and how I see the whole case from an investor's perspective, and you can do your own assumptions and analysis later. All right, so Thomas already covered a lot of this, what is Bitcoin, but still there are some points that I think are the most important ones that clicked with me the most. First of all, it's digital. So like Thomas showed you a lot of gold coins on his presentations. The digital money is something that you would need today. It is global, because if you have internet or even some Bluetooth applications that you can send Bitcoin to peer-to-peer, then you can just send it globally. Then it's decentralized, because there is approximately like 1 million computers running the whole Bitcoin thing. Not getting too technical here, but it's how it works. It's scarce, and that's the one that clicked with me the most. If there's something that is scarce, it means that if something goes down in value, the more scarce one is the better option. If we compare it to like some of you might play some video games, and there is like more rarer ones, items like swords or guns or whatever, and usually it's like green, blue, purple, golden one, and the golden one is the most rare and also the most expensive one in the game. The immutability. You can't change the code of Bitcoin per se. You can do like improvements in it, but you need to have the whole network to accept it, and then you go forward with the like new Bitcoin. There has been some forks along the way, Bitcoin Cash and whatnot. But then the sixth one, store of value, it's somewhat of an arguable one. Some of you or someone else outside this presentation might not see Bitcoin as store of value because of its wild price fluctuations. But we cover that topic later on. So why I'm here? I'm here to tell you about why investors are interested in Bitcoin. Bitcoin is a funny matter because it can be used as money, but still it's an investable asset, and it's like working both sides of the field. But let's tackle these points together. And first off, the volatility. When you talk about Bitcoin, most of you know that the price fluctuations are quite wild, and I cherry-picked 3 of these big drawdowns here. In 2013, in 1 month time, it went down 70%, and in 2018 it was 70% also in 2 months time, and then 2021 in 2 weeks time it was cut in half. So pretty wild ride. And the biggest drawdowns are even bigger, although the time frame is a little bit longer, but still almost 90% from the price, just like that. And that's why people see Bitcoin as a bubble, because you get to see these big rises in the price, but then again, you maybe go down like 90%. But that's a short-sighted view. And if we look at the Bitcoin on, let's look at that later. The first and foremost thing that you hear about Bitcoin is that it is a bubble, and is often referred to the tulip mania we had in Netherlands in the 1700s. And it's a quite good example of a bubble. But if we look at the key characteristics of a bubble, there's 3 things. It's one cycle, as we can see here. We go up and down, and then it's relatively short. It's only like 1 year of this whole mania and coming down. And then we crash to 0, or the inflation adjusted levels. But what about Bitcoin then? If we see the like this whole lifetime graph of Bitcoin, you also see the 2013 drawdown here. Yeah, it's there. You can even see it because it's like a rounding error in the big picture. But if we want to look at the graph in a like more sensible way, we should change this to the logarithmic graph, which looks like this. And there you can see I need to see the prices here. So first off, the price rose from about 5 cents to $32 and then crashed back to $2. And if we had been talking this in 2011, we might have said that, okay, it was a bubble, let's continue whatever we are doing. But then what happened next, it didn't crash to 0. It continued to rise, and it went up to $1,200 and dropped back down to $92. And after that, its price soared to $19,000 and dropped back to $3,200. And each time we went up, and the highs and lows were even higher than last time. So we didn't actually cover all 3 characteristics of a bubble. It's more than one cycle. It didn't crash to 0. And what was the third? But it didn't do that either. And yeah, so that's what Bitcoin has been doing lately, or during this whole lifetime of this. It's doing the exact same thing than any other commodity or stock that is seen valuable. So here are Apple, Amazon, Netflix, and gold. And as you can see, all the logarithmic graphs of these 4 things here go from the bottom left to the upper right. And why do these do it like this? It's because they have like some kind of value in our minds. Even if it's gold, it doesn't generate anything like Amazon, Apple, or Netflix. They generate cash flow from their customers, but still gold is doing the same thing because it is seen valuable. So you can just ask yourself, are these bubbles too? I don't say that Bitcoin doesn't like go to the bubble territory every now and then, but you can say it is a bubble in itself. So then, the next point, inflation hedge. How many of you know what inflation is? So almost everyone, good. If money, let's say euros, we have them, but if there is more of euros, the value of that euro you have in your pocket will go down in value. And that's basically it. And how the whole inflation thing works, nobody knows, and no has any idea how it will go in the future. And as we can see here, the red line here is the inflation rate throughout the years, and these hairs coming off of it are the expected inflation rates or the predictions. And as you can see, they are quite off very often, and even the experts don't know what the hell is going on. But Bitcoin, on the other hand, we know that there is only ever going to be 21 million of it, and the inflation rate is coming down roughly about every 4 years when they have this like halving event, and then the inflation or the price for the whole running the Bitcoin network cuts in half, and those miners will get only half of the Bitcoin what they used to get. And if we have something like this, it's pretty valuable because one thing investors hate is uncertainty, and this looks pretty certain to me that there is ever going to be 21 million. Whereas the whole inflation thing here, we don't have a clue. Yeah. But one thing, maybe Tuomas already opened your minds a little bit, and this is one thing I got this like eureka moment of mine about Bitcoin. You need to have a distinct difference between price and value. Usually we see that Bitcoin goes up in price, and we think that euro is this stable money we have in our pockets or bank accounts. But actually, Bitcoin, because there is only ever gonna be 21 million of them, its value stays the same. It's 21 million, and that's it. And at the same time, the value of euros, because of the inflation, goes down over time. So basically, if the value of euros go down, you need to use more euros to buy Bitcoin. Does that make any sense? Good. And this whole inflation thing, it's not like a random thing we have, because our whole system, whole like finance system works with the inflation. We need it in this system, not like Bitcoin standard, which Tuomas talked about, but this like fiat standard here. It's like incentivized in that sense that if you have, let's say a country, you have lots of debt, and if you print more money, the money becomes less valuable, and you have like this enormous debt. Let's say US, which has the biggest debt nowadays. And if you devalue the money, then the debt is also devaluing. So the payment you need to do every now and then, it's going to devalue. It's easier for them to pay. So that's why they keep printing the money. And then the last one, here are like all the other asset classes we have today. There is gold, Bitcoin, all kinds of stock indexes, commodities, even cash, bonds, whatever. But if we see how Bitcoin is there, the third one. How does Bitcoin act in this like world or spectrum of different asset classes? These are quite extraordinary. These returns it has had throughout the years. I'm not saying that this is going to like continue like this. I don't think so. But still, it's a good thing to remember that it has performed quite well. Some of you might notice that it has this pattern of 3 green years, 1 red year. 3 green years, 1 red year. 3 green years, red year, 3 green. And now when we had this is the 3rd green one, we might see another red year next year. This is because of, or some of the experts explain it because of the halving events, which roughly occur around 4 years. Yeah, actually this is a bit old slide. Actually, Bitcoin and gold are the most profitable assets this year. It's not Bitcoin is not 3rd, but actually the 2nd one. Should have updated this, but yeah. Yeah. So if Bitcoin acts differently than the other ones here, should you consider it as an investor that okay? Because if you study investing at any point, it's always that the only free lunch in investing is that you need to diversify your portfolio to get the best results. So you don't put all the eggs in the same basket and you know the blah, blah, blah. So maybe there is in some extent, there is some place for Bitcoin to be in one's portfolio. This is a little thought play. I played with Excel and I just put 1% of the said portfolio in Bitcoin. And in this example, it's growing 30% per year. 30% is like this. Most experts say that according to this power law model or whatever models they have, 30% is like good amount of returns it could provide the next years. So that's why I put 30% in there, and the other 99% of the said portfolio performs the 7% CAGR, which is like the stock exchange, let's say S&P 500 return throughout last 100 years. So first of all, the Bitcoin, 1% in there, it doesn't even show because it's like so tiny in the whole portfolio. But throughout the years, 25 years, if we go fast forward, it's actually more than half of your portfolio if everything goes like this. Bitcoin goes 30% per year, approximately. It's not that it's going to be like 30%, 30%. It's going to be like sometimes up, sometimes down, but like average. Same goes with the stock exchange as well. It's not 7% all the time, but still, it's a fun little thought play and food for thought. So if you want to have like this diversified portfolio, if you heard something about like Bitcoin or any other asset that comes up in some discussions, and you heard about the risks and all, and you don't want to like put every of your hard-earned money in that asset, you should start like slow and small. And if you have some skin in the game, like I had this even unfortunate event of putting money in it, and now I don't anything else on my spare time than study Bitcoin. But when you have some skin in the game, you become more interested in it, and that is also the point of me and Thomas being here, that you should always study Bitcoin. It's everyone's own decision if they want to invest in it or not. Yeah. Was there something else? No. Okay. So, if you want to get any exposure to Bitcoin, how is it possible? There are like this direct ownership and indirect ownership with these two later ones here. So basically, if you have this direct ownership, you buy Bitcoin from a crypto exchange and then maybe even put it to cold storage, which means that you download it and put it in your like USB stick or hard drive that is offline, and that's the most important part. Pros of this, that it's fast and it's going through 24/7 because Bitcoin doesn't sleep like the stock exchange does. And if you have put it in cold storage, then it's secure as fuck. No one can get to it because it's offline. But the cons. There's this little saying that not your keys, not your Bitcoin. It goes with all of these, but I did put it there. It means that if you don't actually have it in your cold storage and have your keys to it, it's not actually your Bitcoin. So if you have it on a crypto exchange, they might say that you can't withdraw them or whatever. And if you have put it in the cold storage, if the device breaks or you forget the seed phrase, which is like the password to get to your Bitcoin, then you're completely fucked because you can't even get those anymore. But then the next one, ETFs, ETPs, they are not like new products, so to say, but in the crypto field, they are quite new because there is such a demand on the whole scene at the moment. There are like these greedy banks that or issuers that want their share of the whole Bitcoin craze that is going at the moment. So how do you buy these? It's a traditional stock exchange. They are listed, so you can just buy them. The pros are you can use your familiar platform, whatever you're using. And it's also like, didn't put it there, but they're also regulated. So these products are, can't say they are safe, but as I said before, there are a lot of bullshit out there on the crypto world. So when it's like in a regulated market and field, it's somewhat safer. And the cons of this, also the not your keys, not your Bitcoin, but the counterparty risk. So if the issuer goes down, you might not get your money back. And because these are products and services, you might have to pay some management fees for holding them. And then the last one, third one, there are companies that buy Bitcoin on their balance sheet. It's like it's a quite new thing. The strategy, like Thomas mentioned out, that Michael Saylor and his company, beforehand it was MicroStrategy, but now it's a strategy. They are buying Bitcoin on their balance sheet as much as possible. And if you're investing in this kind of company, you might get more Bitcoin over time, because if you are buying directly from a crypto exchange or ETF, ETPs, whatever, you're just like, for example, buying 1 Bitcoin and it's going to be 1 Bitcoin over time. But if you're buying these Bitcoin treasury companies that are trying and even can deliver, that they will grow the Bitcoin per share over time, you will actually get more Bitcoin, so to say, if we go into the future. So basically, if you invested in MicroStrategy in 2024, might be lying, but somewhat right numbers here. 2024 in the beginning, and you held it the whole year. Afterwards, you actually had 1.7 Bitcoin at the end of the year. So it was quite aggressive buying from the MicroStrategy side. But of course, the cons of this, because it gives you more potential and risk goes quite hand in hand with the potential. You actually have all the risks mentioned before, but also like the company risks. The company can go down for whatever reason. The CEO might get mad or whatever. Yeah, so that's basically it. And I think the questions will be quite soon. Thank you.